Good morning, everyone. This is Jim Groark. Thanks once again, for attending. Some of you may have noticed that all phones will be muted during the presentation. What we will do at the end of the presentation today is open up the chat log. If you see on your control panel there, the chat log for questions. Those of you who have logged in and have the control panel, the GoToWebinar control panel, taking up a lot of your screen and you can't see the presentation, there's an orange button with a white arrow in it. You can click on that and that'll shrink that control panel down, and if you want to bring it back up to chat, you can click on it again and it'll open it back up. But again, the phones will be muted today during the presentation, and afterward we'll answer questions via chat. What we'll also do, and I'll remind you at the very end, we'll have a survey sent out to you via email. We really appreciate you taking the time to fill that out and give us the feedback, or give me the feedback. In addition to that, if you want some more custom follow-up, more individualized Q&A, please respond on that survey. We'll follow up with you individually, hopefully answer any questions that may come up. Some of you attending today have had the non-parallel rate shock module for a few months now and have been able to run the module and get results. That's terrific. I'm hopeful this will be of great help to you. Some of you attending today may be brand new to running this module, maybe have not even seen any results as of yet. That's okay. I'm glad you're attending today, because that'll enable our individualized follow-up with you to help answer more detailed questions as they arise. So what we're going to do today is cover a variety of subject matter. We're going to go back to the beginning of this. Where did a lot of this come from? Why are we running this analysis to begin with? There is an interest rate risk advisory, joint agency advisory that came out a year ago, January. We'll talk a little bit about what information is in the advisory. We'll talk about compare and contrast parallel, non-parallel rate shocks. We're going to focus in heavily, for good or bad, heavily on the non-parallel rate scenarios. That is, what rate inputs are coming into the model to give you the non-parallel output. And then we'll talk about the results. What are we looking at here? We'll touch on, at the end, reporting options, some neat little tools you have there to help point out certain information. And we also will review interest rate risk policy guidelines when it comes to non-parallel rate shocks. Starting with the advisory. I don't think the expectation is that you are intimately familiar with this. A lot of it's our job to read through it, understand it, and make sure we give you the tools necessary to meet these requirements. Basically, the directive was that static interest rate shocks in a parallel fashion may not sufficiently capture an institution's interest rate risk. What the regulatory expectations would be for you to run non-parallel rate shocks, that is, different rate indices being changed in a non-parallel fashion. And of course, they use nice, clear language, as always, across different tenors and a different magnitude. What are we talking about here? Different tenors. Different tenors meaning different time frames. Some of you have been asked to run, in addition to a 1-year shock, a 2-year shock. Okay, and your financial compass model handles that perfectly and easily. The greater magnitude of the shock, and most of you are well aware of the need to change your shock increments to at least 300 to 400 basis points. When the advisory came out, we put on a series of webinars, and our recommendation at that particular point was to just go to the 400 basis point shock, at least in the upward direction. Because of the current condition of interest rates, current structure of interest rates, a 400 basis point shock in a downward fashion obviously is not a very likely or reasonable analysis. So most of you have changed your policy guidelines to reflect maybe only going down 200 or 300 on the downward shock. Obviously, most of you well know that the model's very flexible in that regard in changing your shock increments, but one needs to go back to their policy guidelines and make sure they're adjusted accordingly. Why is the advisory asking you to do this? Why are the regulatory agencies asking you to do this? Well, a parallel shift in rates, the assessment of yield curve risk, that is, different points of the yield curve changing by different increments, is not captured. And if you go back to the various types of interest rate risk, yield curve risk is one type that needs to be addressed. I did manage to do a little research and pull up what we're going to call the Bible or source of a lot of the regulatory language in the states, and that comes from the Basel Accords. Obviously, most of you are familiar with that, with the capital requirements and the changes there. But also the Basel on interest rate risk is a lot of information the United States regulatory agencies glean is from the Basel Accords on interest rate risk too. Definition of yield curve risk is the change in the yield curve affecting income as well as market value. And there's a somewhat complicated example there that they give in their language. But basically, if you're tying certain instruments to a short point on the curve, say the 6-month Treasury bill, and you tie other instruments to a longer point on the curve, say the 10-year Treasury, if those indices change by different increments, then the result you get in the risk analysis is much different than if you change both the 6-month Treasury and the 10-year Treasury by the same amount. And that's all they're trying to say is you need to capture that variable. The Financial Compass model, this module, as you will see when we talk about the rate inputs, the Financial Compass module addresses all of those concerns. In addition to capturing yield curve risk, the expectation is you will capture repricing risk. Look at a basic gap report or rate shock income, you're capturing that. Option risk and optionality, most of you are familiar with that term. Basically, prepayment behavior, okay? Things are not behaving in the contractual manner. Interest rates cause cash flows or payment streams to change depending upon the interest rate environment. And the other type of risk being basis risk, where instruments are pegged or tied to different indices quite literally, so those indices don't always change by the same increment. We're going to take a step back, and we're going to focus in, obviously, the yield curve risk and what sort of ramifications that can arise if the yield curve changes by different increments at different points. What Basel also recommended, and I'm going to pause a second here because there might be a slight delay on your end here, so I'm talking very slowly. What Basel asked in evaluating yield curve risk would be have some basis for the rates that you're inputting into the model. We're going to talk about that. That's one point when you leave today that I'm hopeful I explained well enough that you're very comfortable with. Because what basis do you have for the rate inputs into the model? When the joint policy statement came out, we did have materials available to our client base because this module was not available. So one could run a non-parallel rate shock and mock it up manually. And we developed step-by-step instructions. Some of you had requested those instructions. They were very easy to follow. You didn't have to pay any extra. The model had it built in. But it required some manual work. The main issue with performing that analysis manually, the main issue our clients faced would be what rate inputs do I put into the model? How do I determine what type of non-parallel shift to put into the model? And obviously at that time, I did not have any real basis for, well, try this rate environment or try that rate environment. We had an idea, because of the way rates were structured at the time, which is not that much different today, what type of yield curves the regulators would want to see, say an inverted curve or a flattened curve. But we had no basis for it. We were, in essence, making it up. So that was our directive in developing this module, is to give a foundation for the rate inputs. So you can explain to the board, to the regulator, here's where these rates are coming from. Here's why these are valid rates to test. Here's why these rates are sufficient from a stress standpoint, or sufficient from a likely and unlikely environment standpoint. And the red part here just highlights the main point of statistical analysis being used to evaluate that assumption. And we're going to talk about that, because that's exactly what we're doing with the non-parallel rate shock module, is using a statistical basis for the rate scenarios to back them up. You got to be able to back them up, and that's what we do. So let's talk about rates. As most of you are familiar with, if not all of you, a traditional rate shock is going to take a current interest rate environment, and that's the orange line base. Okay, that's the current yield curve. And we're going to run an interest shock on those rates, 200, 300, 400 basis points up and down. And as you see in the traditional rate shock, their rates are moving on a parallel basis. The short part of the curve is changing by the same increment as the longer term rates on the curve. Okay? And again, the joint policy directive is you're not really capturing yield curve risk where maybe the short point doesn't change and the long point changes. Okay? So obviously, knowing what we need to do, we need to put in various rates that capture just that behavior. And as you see, based on the current curve, there are various interest rate environments that we need to put into the model to capture the yield curve risk, the non-parallel change in rates. Okay? Incidentally, this is a treasury curve, and going forward in the conversation, when we talk about a treasury curve, that's what we're going to focus in on from a rate input standpoint. We're going to use the treasury curve with an added overnight point as the shortest point on the curve. We're going to plug into the Fed funds rate there. Okay, so it's essentially a treasury rate curve with the Fed funds overnight rate. But as you see there, various points on the curve are changing by different increments. The important point, and I'll probably say this a couple times to bore the heck out of you, the important point here is all of the non-parallel rate environments that we're going to run through the model from here on out are going to be based upon the current curve. And that's very, very important, because what happens is your rate inputs, your treasury rate inputs into the model will dictate what form the stress curves, what form the stress rate environments take. So it's very, very important, and in the sales presentation that I was part of, it's very, very important that one has the current treasury curve in their model. Again, some of you are familiar with our rate risk bubbles. Just from a visual standpoint, what is the non-parallel change in rates? What is a non-parallel yield curve shift capturing risk-wise? As you can see, here's an earning asset bubble and a liability bubble, and their position in relation to the curve is very, very important. And their position, we're not going to get too far into it duration-wise, how far out they are in the curve is important too. Noticing that the liability bubble there is right on the yield curve at its particular point. If we change the yield curve in a non-parallel fashion, it's going to affect the assets potentially differently than the liabilities. And in this example, if we have the liability bubble that far under the curve, obviously that's a very good thing for us, isn't it? And the further out on the curve and the more it's under the curve, even better. We're paying way below market rates. But when the yield curve shifts like that, and I like this visual here to give you a visual as how it's affecting your assets and liabilities, just strictly say from an EVE or market value standpoint, it's going to affect those values differently depending upon which part of the curve is changing. So it's important to focus in on the relativity of your assets and liabilities to that curve. As I mentioned before, we need a current Treasury curve in the model for this module to work properly. So after we finish today, at some point in the near future, you definitely need to double check this. We're fairly confident through all our interactions with you over the years and the webinars we put on each fall, which cover all the assumptions in the model. We cover this point that you need to have updated rates. Okay, every month, what most of you do is you pull down either a professional rate forecast, which is the blue chip, or you pull off a rate update file from our network and you load it in to your rate forecast screen. And it updates these rates. Remember, when you run a rate shock, whether it be parallel or non, the rate environment that's shocked is the current rates, or the first set of projected rates. In this particular example, this plan is updated through the month of March. So when we run a rate shock on the March results, it's taking the current rates as of April and shocking them up and down. Again, in a parallel shock, each of these rates, as well as other indices, will change by the same increments. In a non-parallel shock, you may see Fed funds, the 3-month Treasury, remain exactly the same. And you may see other rates change by different increments, depending upon the scenarios that we're talking about. But the important point is, this information to use this module needs to be refreshed. It doesn't have to be the professional rate forecast. It doesn't even have to be the rate update file that you load off of our website. If you manually type them in, that works too. Doesn't matter. But they need to be current, because the scenarios you're going to download, and we'll talk about that automatically, will be based upon this particular set of rates, the first projected month's rates. And going into Compass, here's an example of a rate forecast. Actually, this is in the latest version of the software. Most of you have updated very recently to our version 8.3, which has this module, and we'll be putting out an update in the next couple weeks to that. We had a little bit of an issue with an update, but that will be resolved in the next couple weeks, which will actually, if you notice, in the upper left-hand corner is a little different display. It's going to actually tell you if your rates are current. Isn't that nice? If they're not current, you get a little message in red telling you that they are not current. But don't look up there and say, hey, wait a second, my rate forecast screen is different. Yes, it is, but it'll match this very, very shortly. So as I mentioned before, we not only have this Treasury curve, again, using Fed funds as the shortest point on the curve, but you have other rates there too. What are we going to do about those other rates? We're going to talk about that, because we actually have some fairly sophisticated modeling that's going to say, if the Treasury curve looks like X, prime will do Y. LIBOR will adjust automatically. And all of this is automated for you. Because again, I'm going to come back to when this first came out, the biggest hurdle was, what rates do I put in here? And as you may already know or will see, we've taken that guesswork out. We're going to give you a basis for that statistically, mathematically, but we've taken that guesswork out, and that's all fully automated. Push button. So when we talk about the model and we talk about the rates, let me go back to the update of the rate scenarios. We want everything to be automated as much as possible. When I go to Compass, I can see, and if you have this module, you're going to have this non-parallel rate shock button here. When you first go to this module, and I'm going to say yes to this rate forecast information, you're going to get a prompt here. Okay, this is actually set up, as I showed you, in the utilities. It's going to default to giving you this prompt at all times. I say leave it at this setting. Okay, you'll get a prompt every single time as to whether or not you want to update the yield scenarios. You're going to do this once a month, just like you update your rate forecast information. So when you go into the non-parallel rate shock screen, you'll get this prompt, and you're going to say yes. Okay. The only time you're going to say no is if you open up an old plan. If you open up an archive, let's just say for whatever reason you didn't print something out from last quarter end and somebody's asking for it, and you go open that up, and you go, let's say you go to this non-parallel rate shock screen, you're going to get a prompt here. If you're opening up an old plan, do not say yes, because that would pull in the current scenarios into an old plan. Just like you would if you went into the rate forecast screen and loaded in the current rate forecast information into an old plan. You don't do that. Okay? But for the most part, on your current live plan, the first time you're going to run the calculations and look at the results, you're going to say yes. My stuff's already loaded here, so I get to say no. I'm going to see a screen that looks something like this. We're going to take this apart together. The important thing to know is when I say yes every month, I will be loading in these rate scenarios. Now, there may not always be 8 rate scenarios. Remember, these rate scenarios are always based upon the current level of interest rates. If I look at the middle of the screen, this scenario number 1, the darker blue line, the lower line, is the current yield curve as loaded into my model. If I did not have my current yield curve loaded into the model properly, I may see a wacky set of interest rates here. And a lot of the modeling behind the scenes won't work properly. So again, to overemphasize that point, those of you who know me know I do that sometimes, overemphasize that point, you got to have the current rates in here. I look at the current interest rates, the lower darker blue line, and then the lighter blue line is the scenario that's been loaded here. These scenarios at left are the ones that I'm pulling down automatically each month. Depending upon the current curve, we may have as few as 4 or 5 scenarios. The first 3 scenarios that you will load will be the blue chip plan, that will be scenario number 1 at all times. The blue chip high, scenario number 2, and the blue chip low, scenario number 3. What are we trying to do with these? Well, these are professional rate forecasts. What we're doing is we're taking the blue chip forecast 1 year out. Okay, whether you're running a 2-year shock or not, we're going to take forecasted rates 1 year out, and we're going to run the non-parallel analysis based upon those rates happening overnight or ramping to those if you choose the ramp. I would not suggest you have the ramp setting on because most of you are going to be running the parallel on a non-ramped basis. I would also suggest that you have this setting here. You see shock, current, balance sheet, and rates 2 years. This should also be set in conjunction with the parallel rate shock time frame. If you're only running 1 year shocks, you're going to run this on a 1 year so you can have an apples versus apples comparison. In this particular instance, I've got the blue chip plan as a 1 year out. Okay, that's an immediate shock, so rates are changing to that overnight. That's the consensus of the 50 economists. For those of you who do not know or do not subscribe to Blue Chip, you don't have to. You're getting this scenario automatically. The Blue Chip High, we take the 50 biggest name economists in the country. They give us forecasts. The plan is the consensus or average of the 50. The high rate forecast, we take the highest 10 economists' forecast and average them. And then low, conversely, is the lowest 10 forecasts for each rate index averaged together. Again, these are what they're saying. Rates are going to be a year from now. And then when you run the immediate rate shock, that means it changes that yield curve overnight. What's interesting to see here, to most of us, interesting, these are somewhat parallel shocks. You can see from the current curve to these curves, parallel shocks. And the low forecast is basically saying there will be no change in rates over the next year. Okay? Some of you have already noticed on the left-hand side that some of these scenarios have a preview color of either blue or red. Okay? What does that mean? Well, when we're talking about blue or red, the blue statistically are classified as likely scenarios, and the red statistically are classified as unlikely scenarios. If I look at this scenario number 6, it's a steepened curve, whereby there's a small change in short-term interest rates and a more significant change in long-term interest rates. It's showing up as red. Why is that? What the model will automatically do for you is analyze the likelihood of the current curve moving to a curve of that shape over the rate shock time frame. Okay? I have a 2-year time frame selected, so the likelihood of the current curve moving to a steepened curve of that form is classified as unlikely on a statistical basis. Okay, there is detailed information in your Risk Compass report package on that, and we're going to talk about that in a little bit. All that fun statistical information. But the goal here, and this is what we're going to focus in on, the goal here is to run through the model likely scenarios, professional forecasts here, where professionals are saying, here's where rates are going to be a year from now. Let's change rates to that overnight. And stress environments. What do I mean by a stress environment? Well, a stress environment per the parallel rate shock, in most cases, is a change of at least 400 basis points, isn't it? I want to make sure I'm shocking my model at least 400 basis points in a parallel fashion. We're using the same criteria for the non-parallel. If you notice in this steepened curve, we have a significant, that is, at least a 400 basis point change in long-term rates on this curve. And that is being considered as a stress environment. Okay? So what you want to convey out of this is we've got likely and unlikely scenarios. The scenarios will include a professional set of forecasts, Blue Chip, and we're also going to include some substantial changes in rates, okay? All relative to the current yield curve shape. Another curve based upon today's level of interest rates that the regulators would want you to test is an inverted curve, okay? That short-term rates spiking suddenly, long-term rates remain relatively unchanged, okay? What's very interesting here is, statistically, if we look back over 20 years of interest rate history and we calculate the likelihood of this rate environment on a 2-year basis, it's classified as a likely, okay? Incidentally, the unlikely scenarios would be classified as those happening in 3% or less of the yield curve changes that have happened over the past 20 years. Okay, that's what we're going to use as criteria, the statistical basis for our likely and unlikely scenarios. So what's interesting here is the model is saying statistically that inverted curve on a 2-year basis is calculated as a likely, one of the likely events. And what I'm going to do here, just for fun, is change this to a 1-year basis, and it turns red. Again, what that's telling me is, on a statistical basis, the current curve changing to that shape on a shorter term basis is unlikely. And guess what? You know what? That kind of makes sense here. What also should make sense is scenario number 4. Again, based upon current interest rates, there's a lot of talk at year end about a double-dip recession and a flattened yield curve. And this is an extreme example. We're changing rates by 400 basis points here. An extreme example of a flattened yield curve, a change in long-term interest rates down. But you see it's showing up as a likely scenario on a 1-year and a 2-year basis. And again, from the relative position of interest rates today, that's a classified as a likely scenario. Now, what we want to do is talk about the rate inputs, the Treasury rate inputs, these scenarios, but also about the other rate indices that you may have accounts tied to in your model. If you notice here, for each of the scenarios, and I'm going to click on, let's go to my steepened curve. This is what you have downloaded. When you say yes, and you go into this module, this is what you're downloading. This rate environment, okay? An unlikely rate environment, a substantial change in interest rates. What the model is also going to do is, based upon this particular interest rate environment, it's going to help us forecast what these rates are going to be, okay? Prime, LIBOR, etc. These are not part of the Treasury curve. We could have created different curves. We could have shocked a LIBOR curve on a non-parallel basis. We're not going to go crazy with that. And actually, there's a reason why. What we're going to talk about in a little bit is, going back again over 20 years of rate history, we actually research automatically the correlations between these particular interest rates, the ones in pink here, and how they change based upon Treasury curve changes. And the results are very, very interesting. We're going to get to that. But the beauty of it is, by downloading these scenarios, the Treasury scenarios, these rates automatically change. Okay? So if Fed funds changes to 155 here, we're getting a change in prime to 457 automatically. Now that's automatic because these are checked. And those of you at home, when you go into your model and look at your settings, these will default to checked, meaning I want this to be automated. If I uncheck this, then I'm going to need to put a manual interest rate in for prime. We're going to talk about that, putting your own rate environments in there. Our advice to you, my advice to you, let everything run automatically, because that'll give you the best results and obviously be the least amount of work that you're going to have to do. And that's what it's all about, isn't it? Quite frankly, that's why we developed the module, and the powerful math behind the scenes is to take the guesswork out of these rates and to actually have you focus on the analysis and the output rather than the inputs. So we're going to talk about likely and unlikely scenarios. We cover the non-parallel and what's likely and unlikely. We do have to talk about this fancy math here. Now, I'm not a mathematician. I have programmers here that I consult with, and they explain all these complicated concepts to me. When I talk about a statistical analysis going back over 20 years and giving us basis for our rate scenarios, okay, so we can back them up. What are we doing here? Well, when I started asking the questions, I was told by the programmer, Jim, don't try and visualize this because you can't. But there's standard statistical analysis that you can apply, multilinear regression, which basically going to look at every single yield curve rate, okay, and it's going to actually use the rate history basically to have some way of predicting what non-yield curve rates are going to be. For example, if I look at a prime rate and I compare it to each point on that Treasury yield curve, remember our yield curve is going to include Fed funds. Aha, Fed funds and prime. So if I go back and look at changes in that curve, including the Fed funds rate over time, and look at prime rate, you can guess right off the top of your head, can't you, that there's going to be some correlation derived. Okay? So we do that for every single non-Treasury index. LIBOR, we're going to look at the 1 month, 3 month, etc. We're going to look at Treasury rate changes, and we're going to see if there's any correlation between the Treasury curve changing and those LIBOR rates changing, and all the other interest rates that are non-yield curve rates. So all of this, mumbo jumbo, this math behind the scenes, is developing formulas. So when I do put in a crazy yield curve in there, I can get some reasonable non-yield curve rate inputs for prime, LIBOR, the 30-year fixed rate mortgage rate, etc. And so we do all that math behind the scenes for you. And that's the all important point, is you don't have to do that. It gives you a basis for the non-yield curve rates also. Okay? So it's kind of neat how that works out. We're going to talk about some of those outputs when we look at the reporting. We mentioned here in R squared, and those of you who review prospectuses, you look at investing, fairly common term, the relationships, okay, correlations. Standard term, but basically what we want to use or what we want to implement into our model are R squared factors that are higher, right? Because the higher the correlation, the more confidence we can have in the results. What results am I talking about? I'm talking about when the Treasury curve looks like X, prime is going to look like Y. When the Treasury curve looks like Y, the 1 month LIBOR is going to look like Z, okay? And we're going to have some confidence that we're going to get some good rate input into the model for the non-yield curve rates. So when I talk about the correlation and the fancy math behind the scenes, and when you look at your model, you're going to see something similar to this. These rates will change over time, right? You are updating your information every single month in the model. So these will change. But looking back over 20 years, these have held true pretty much. And the example of prime, looking at Fed funds, okay? So when the yield curve changes, we know we can get a reasonable forecast for prime because of this high correlation. What's very, very interesting to most of you, I think, maybe not to all of you, look down in the junk bond and the muni bond, state and local municipal bond rates down, the correlations down there. Those are much lower. And I would say, in my estimation or my advice to someone, if a correlation is that low, I would say that may be borderline unusable or not, I would not advise that you use it, a correlation that low. Why is that? Well, the main issue going back is looking at the financial crisis and what happened to junk bonds and municipal bond rates over that period of time. They went kind of haywire. So a lot of this correlation analysis obviously picked up on this, and that's showing up in these correlations because things did get a little wacky at that time. Going back over 20 years, I don't know if there was any other period there. But most definitely, most of you know off the top of your head, those rates did go a little haywire for a period of time, thus throwing off these correlations. Okay, so it makes perfect sense why those may not be very usable correlations in the model. But at least it gives us some basis. I say state and local is kind of borderline. It's almost 80%. So what sort of cutoff would that be? 80% or higher, I would say, would be something that would be somewhat valid. The junk bond there is below that. So we are going to change in the Compass model scenarios. You're going to download them. We are going to change these rates automatically. Let me just go to the high flat, and you're going to see these rates change. Okay, so you see the scenario changes. These change because I have these checked. That's all fully automated. Is it the second or third time I've mentioned that? What you're also getting, because some of you may have custom drivers, that is a rate index that you set up on your own. These, I'm going to tell you off the top of my head, these were set up as floor models in the software model off a prime rate. So because these are checked, whatever prime rate gets plugged in the model, these will change automatically. There's an issue. Some of you may go into the software and see orange rates and no checkbox, or NA. What that means is you have a driver rate, an index in your model that is not tied to anything. So the problem is going to be if you load in 100 different treasury curves, doesn't matter. You're going to get these things forecasted for you automatically. But the rates that are not checked, the rates that are marked NA, have no basis, no relationship, okay, to any of these. They're not going to change. No, it's a good thing or a bad thing. The first thing I suggest you do, if you're running the model and you see that right away, that you have some rogue drivers, see if there is some relationship you can make to the Treasury and the blue and the pinks. Okay, set that up as a driver model. If you're not familiar with that, or you need to run that by one of us here, give us a call and Compass support. Set up a driver model that makes that linkage. That way, this thing will be checked and it'll automatically update. If there's absolutely no relationship to any other index, and you want to use that in the non-parallel analysis, then you may be forced to type it in. And you can't. If this box is unchecked, you're going to see it displays like this. I'll slow down a little bit here. This box is unchecked, then you have to type. You can type in that rate, what you want it to be in that particular non-parallel shock scenario. The caveat, though, is I'm going to have to go to each scenario to type that thing in manually. So obviously, the best of all worlds is to have that checked, have it linked, and have it automatically update, and have all that math behind it to help us, give us a good forecast depending upon the yield curve you're downloading. One also has the option, just to show you, to input their own, I apologize, the non-yield curve rates, we covered that, as well as the custom. One also has the option of creating new scenarios from scratch on their own, adjusting a scenario or two. That's up to you. If I go into the model, you notice when I click on each of these scenarios, this twist name pops up with a deactivate button. Let's just say I don't like this particular rate pivot and I want to deactivate it. I could go to this new button over here in the bottom left and set up my own twist, name it, and activate it, etc. I can only have 8 rates there at any given time, so it's not going to use the short-term pivot in the analysis. It's gone from the analysis. If you want to set up more than 8 scenarios, you're creating your own, you can create a separate folder and set those up. Our goal, obviously, for what you're paying us for, is to provide you automated downloads, push-button functionality that satisfies every regulator's curiosity as far as a likely scenario or a stress environment or unlikely scenario. That's our goal here. So if you get a question or an examiner is asking a question about that, please put one of us on the phone, give us a call. We'll talk to them. This is new for everyone. There's going to be a lot of questions. There's growing pains here. There are some features here that we've added that will be in that update that's coming out in the next 2 weeks that some of you may not have, that we've added to the software as a result of input we've gotten from our clients and the regulatory agencies on this module. There's going to be a learning curve here as this is reviewed and examined. But please, give us your input. I don't normally suggest you create your own scenarios, but you certainly have that option. Okay, and if you wanted to do that, I could take this scenario and I could just type in the rates here. Guess what? These are checked. These will automatically change in accordance to the statistical analysis behind the scenes. somebody says, check this curve, and they give you a spreadsheet. Copy and paste it in here. Again, these will change automatically. Okay? You just need this particular curve as input. I'm highlighting the result column because that's what you want to type in. Those are the rate environments here that we're running through the model. Okay? Again, normally don't suggest you change things here, but if you have to, you can. So when I do create a new curve, I can type in rates. It'll change the curve. I'm going to change Fed funds to 4.23, and it goes, woo, there you go. Obviously, that's a wacky curve, and it turns red, doesn't it? Hey, the model's working. Or I can right-click and then drag the curve up and drag various points. There's tricks to it. Again, our expectation is you won't have to do much of this because whatever we're providing you automatically is more than sufficient. There's a report in the Compass software that lists, it's in the Risk Compass report package that lists all the various indices. What the new version will enhance is the legend. You notice, I'm sure some of you look at that legend right there and say, wait a second there, I don't have that. You're correct. Based upon input from our clients, we've made better labeling here so you understand exactly what you're inputting instead of scenario 1 through 8. That wasn't very descriptive, was it? Also, the rate environments there in the spaghetti bowl some are bold and some are regular plain old lines there. The bold lines, and what you'll notice on the actual rates, the report of these rates, the bold lines are the unlikely scenarios. The unlikely scenarios, the actual interest rates in that report will have an asterisk on them. Because this is being done on a 2-year basis, there are 2 unlikely scenarios, and that would change. If I change the time frame to a 1-year basis, remember that inverted curve changed to red, that would show up as bold here if I were running this on a 1-year basis. But the idea here is to give you better labeling, and you can also change those labels if you want. I wouldn't suggest you change the blue chip labeling. Those are going to be the same every single month. But if you wanted a more descriptive name for the rest of them, you certainly are welcome to go ahead and do that. You can go ahead and type that in here in the twist name and do that. It will repopulate with the default name next month when you load it in. Now, as far as the inputs are concerned, I'm hopeful that you're more comfortable with where these rates are coming from. That is, the Treasury curves. Where these rates are coming from, that is other indices you have in the model that you have accounts linked to in your pricing. The statistical basis for changing those rates. And that's something you want to have a comfort factor in explaining to others. You don't have to get into a complicated description of what an R-squared is. It's a relationship, it's a correlation, how well it follows something there. But that's the meat of the software. The hardest part for us, and what took a while to develop, is that statistical basis for what we're doing input-wise. Let's come away from the input and talk a little bit about output. Okay, what sort of output options do you have for viewing the results? And again, some of you may have been running this for a while, so you are more familiar with the results. Some of you are fairly new to this, and you haven't had time to review the results in detail. We're going to review some generic results here, but please, what we've done with everyone who signed up with this module is taken the time, at least for a month or quarter or two, to look at your results with you and to talk about your individual results. That offer stands for everyone, so again, respond at the end of this with the survey. If you'd like us to do that with you, that's what we recommend we do, so you're more comfortable with it. So we're talking about the results. A couple of options at your disposal. When you run the module for the first time, what you're going to end up with, in addition to your regular rate shock report package here, are NP for non-parallel. All the reports that are in the parallel shock package are available here, with obviously a few additional ones. The rate shock detail is giving the rate scenarios, and again, there are asterisks here to denote the unlikely scenarios. I apologize, I always go to stuff that you don't have, but again, it's going to be in a matter of a couple of weeks here. Non-parallel charts were added. I'm going to kick over in a second. Those of you who look at the risk compass package are familiar with those. And so we have the various charts available in the compass model itself. If we talk about the risk compass package, those of you who are running this module use this as your primary focus, your primary set of information for the board and the regulators when it comes to your rate shock. We've got the additional information here on the non-parallel shock. If you've looked at the report on the parallel, we separate that section out from the non-parallel in describing what the model is doing. And in bold there, you're going to see the time frame you're running it for and whether or not you're running it ramped or immediate. Again, that's information that you've needed to convey to the board and the regulators before. We didn't have any forum for that. We've added that to the risk compass package. If you look at the actual results, I'm going to scroll through here a little bit. The executive summary. Again, those of you who are familiar with this, financial results for the month, and we have a gap report. I'm going to talk to you a little bit about the guidelines and how to input them into the model. You see there's a little red print here because from the gap perspective, they're outside of their policy guideline. I'll show you where that goes in. What I wanted to point out here, though, on the parallel results is, number one, we're labeling them as parallel, okay? So we know that this is the set of parallel results. And you're going to see the income simulation, as we saw, is being run on a 2-year basis, so it's going to be designated there. If you change it to 1, it'll say 1. And then the ability to enter the risk guidelines there below each set of numbers. Because of the fact that we don't, number one, have enough room, but we're still working on a presentation for having you, giving you the ability to enter all of your guidelines. We're still working on a nice generic format for that. Allow you to do it in a custom fashion. You're going to be picking one particular rate point. So what you probably want to do here is put, instead of maybe 200, we're going to put maybe 200 down or 400 up. Whatever your policy guidelines are, what the outliers are from a guideline perspective. So if I'm going up and down 400, I'm going to put my 400 up and down guidelines here. Page 6, we're going to see the non-parallel results. Okay. Again, the chart pretty much is the same as you're used to. The legend will be changed to be more descriptive. And what we're looking at here, in this particular case, which I'll show you in a second, we've actually added a feature where you can put a maximum percentage change. Previously, it was a minimum margin from the risk tolerance report that would pop up in here. But if you're going to put a maximum percentage change from a policy guideline standpoint, our suggestion is to put in the highest rate shock increments percentage change. Now back to policy guidelines and non-parallel. There are no hard and fast rules here. We have not received any specific guidance, and I haven't heard anything from you all, from the regulators as to what they want you to see, what they want you to put in here. So the best advice that we can give is, because we're putting in scenarios that have a 400 basis point rate change, either short-term or long-term, then you probably want to take your 400 basis point percentage change, maximum allowable change, and use that as a guideline here. Or not put a guideline at all. We have not had anybody pressed to put a guideline. But as far as the results are concerned, we have not seen anybody run into any trouble putting in a maximum percentage change that's based on their 400 basis point parallel. So you see all the results here are above the line, which is a good thing. Scenario 0 is labeled current rates. Remember, when you do a parallel rate shock, there's a 0 point in the rate shock, and that 0 point is the current interest rate environment held constant for whatever period of time in the income simulation. Again, we're doing this for 2 years. So in a non-parallel rate shock, we are comparing back to the same 0 point as the parallel. We're starting with the same base. Here's the current interest rate environment, right? Here's the current treasury curve, here's current prime, etc. Hold those rates constant for 1 year, 2 years, whatever you're running your income simulation for. That's the 0 point here, same as the parallel. And then we're going to show where you have the worst outcome here on the chart. And that is scenario 3 and 4 for the income simulation. What you may also notice here is there's some additional language on the report. You have the ability in the model to go ahead and enter. There's a couple places you can do it. I can go back to my non-parallel. Reporting options down here. You can enter language concerning the margin and EVE simulations for the non-parallel. Okay. This is just sample language, just basically illustrating that we are putting in some likely scenarios here based upon blue chip, and then we are also assessing unlikely scenarios and telling them exactly how you feel. Tell them exactly how you feel about those unlikely scenarios. But it's just some sample language. Any of you out there are in need of some sample language like this, if you've been asked to enter the commentary, you're free to copy off of us. We'll send that off to you. Not to go too far into it, this is the equity EVE simulation on a non-parallel basis. Presentation is the same. Okay, we're comparing the EVE results for each of those scenarios, and we're comparing them to the 0 point. I didn't really get into the math on how these non-parallel results are calculated. Some of you over the years have asked us, for guidance or coaching on how to compute the parallel rate shock results, and we sent you a proof sheet. I think it's very handy because if you prove out the results, light bulbs go off. Oh, okay, so that's a parallel rate shock. Okay. The computation, the mathematics here in the non-parallel are exactly the same. The only thing that's different are the rate environments. They're changing on a non-parallel basis. The mathematics are the same. So the instructions, if you have them out there, you can take these rate scenarios, you have the rates available, and you can do your own proofs just to see what's happening. But my thought is if you understand the parallel, you're going to understand these because it's mathematically the exact same analysis. We're just putting in some different rate environments. You also have the ability, more options here. I apologize. I'm going to go to access via risk compass, access via compass results, and we cover the EVE. Those of you who have the Excel add-in, we've added the non-parallel results. We're calling it yield shack data. We've added those results to the add-in, so if you're using any custom reports in your parallel, you want to do the same for the non-parallel, all the same information is available in the non-parallel. So you can create those custom reports in Excel. What's very interesting here, if we look at the results, here goes my chart, of course, that none of you have. What I find very interesting here, remember the bubble chart we started with. We're talking about a little bit about analysis here. The bubble chart we started with, our assets were much shorter than our liabilities. And if we look here from an EVE standpoint, what's bad for assets from a market value standpoint? Rates rising, right? If you notice here, scenario number 8, that is the worst outcome in the non-parallel analysis here in the EVE. What was scenario number 8? Scenario number 8 was that crazy scenario where short-term rates rose 400 basis points and long-term rates didn't change. So my assets are shorter than my liabilities. There's more of an impact on them with just short-term rates changing, isn't there? So all the stars are aligning here. Hopefully some light bulbs are going off. That's having the worst impact because it's affecting my assets more than my liabilities because they're shorter term, okay? So a lot of this should make sense. Whatever rate scenario is being run through the model, based upon your bubbles, that's why those bubbles are nice, based on your bubbles, whatever duration your assets and liabilities have, you should be able to tell which is going to have the greater impact, which scenario is going to have the greatest impact on your particular institution. And in this case, it all makes sense that crazy twist scenario number 8 had the greatest impact because of my structure of my balance sheet. So the results are available in a lot of different formats. One handy thing, again, some of you may not be familiar with here, in the Risk Compass settings, when you run your Risk Compass report, touch base with us because there's an option here that a lot of you may not be taking advantage of. That is to put your bank logo on the cover page. And you see there the checkbox is signed, use logo, and we've put that, and obviously it's going to look much nicer in the presentation. You want to make sure that your logo is available in a bitmap image that's a BMP file, and you can ask any of your techies to give you a copy of our artwork in a BMP format, and that way you can link it up by clicking on that browse button and selecting that. You want to leave that BMP file in the same exact place. Maybe put it in with your program or something like that. Will help you with that because it's always going to reference that image every time you run your Risk Compass report, and you want that image to be in the same spot. Guidelines. And we talked about guidelines as far as putting your outliers or your more extreme parallel shock guidelines in for your non-parallel. This set of input, this is for your Risk Compass report. This set of input is available by going to Utilities and Options and clicking on this Reports button. If you don't have a gap policy guideline, uncheck that. Don't show it. If you don't have a non-parallel policy guideline, uncheck that. Okay. If you're putting in your parallel, choose the lower and upper at your extremes in the report. But you want to make sure that the report conveys that you're okay. If you're outside your policy guidelines, obviously you've got some explaining to do. And the current interest rate environment, actually, there are some issues with gap and some of the simulations. But if you don't have a gap, leave it off. And if you don't have a non-parallel, leave it off. If you're developing a non-parallel, you're going to want to consider the maximum change on your parallel rate shock. Reviewing. What do I want to take away from today? A lot of stuff. Hopefully it's a lot of good stuff. We're running through the model, likely and unlikely scenarios based upon the current Treasury curve. Okay, likely, starting off with the first 3, likely, blue chip, professional rate forecast. You don't subscribe to blue chip? That's okay. We're going to give you those 3 forecasts. Unlikely, stress environments. We're running through stress environments. At least 400 basis points change to the short-term and long-term parts of the curve. We are basing that on statistics, okay? This will change over time. The Treasury curve is the basis for changing our scenarios. Treasury curve, right, with the overnight point being Fed funds, okay? You're going to be doing, you have the option to do 1 and 2-year rate shocks, right? Different tenor. We're crossing that off our list. And different slopes and twists of the yield curve. You're getting that all automatically. Not just the Treasury curve, but other interest rates. They're forecasted using that correlation analysis. You don't have to know a lot about it. It's a standard math. What you do have to know is we're going back over 20 years, and we're developing models that will help us forecast what prime, LIBOR, etc. will be doing based upon each Treasury curve you download, okay? So when you download those Treasury curves every month, we're getting those non-Treasury curve rates forecasted automatically based upon all the fun math behind the scenes. That should give you confidence that you're getting a good input for those. I'm confident. You should be confident. Chances are, your first interaction with the regulators, if they're asking you questions, you may not be. That's okay. I've been there because this is relatively new for everyone. Please give us a call. Please run your stuff by us. Please, if you need to, put us on the phone. We prefer to see your results first before we get on the phone with the FDIC, OCC, et cetera. But please, use this as a resource. That's what you're paying for. So I'm hopeful that you did learn something about what you have. You are better able to explain it to others. You have more confidence that whatever rates you're downloading when you say yes will be sufficient to stress test your balance sheet and sufficient to uncover your yield curve risk, right? Yield curve changing by different increments at different points on the curve. I'm